So what happens when the markets start getting choppy and inflation is quietly eating away at your savings? Well, just crossing your fingers and hoping for the best? That's not really a strategy, is it? The real question is, how do you actively defend your portfolio? Today, we're going to dive deep into strategic hedging, basically a way to build a financial fortress against all that pressure from inflation, especially when it's being fired up by something like high energy prices. And let's be totally clear, this isn't some abstract idea from an economics textbook. Inflation is a real, tangible threat. You can think of it like an enemy that's actively trying to reduce your buying power every single day. So to beat it, you need a plan, and you need the right tools. Let's get armed. All right, so here's our game plan. First, we're going to get to know the enemy. What is this inflation thing, and what does oil have to do with it? Then we'll get into the right mindset, which is really your first line of defense. We'll look at some classic safe havens, maybe kick the tires a bit. After that, we'll check out some more advanced tools. And finally, we'll put it all together to see how you can build your own financial fortress.
Okay, let's jump right into section 1. You might be wondering why the big focus on oil. Well, it's because it's one of the biggest, most powerful drivers of the very inflation we're trying to protect ourselves from.
I mean, just think about it for a second. Oil is in, well, almost everything. It's not just about the price you pay at the pump. It's the fuel for the trucks that deliver your groceries, the ships that bring goods from all over the world, and it's even a raw material for tons of products like plastics. So when the price of oil goes up, that cost has to go somewhere, and it ripples through the entire system until eventually you and I are paying more for, well, everything.
So inflation isn't just one thing. It really breaks down into two main types. The first is called cost-push inflation. This is exactly what happens with an oil shock. A war, an embargo, some big supply disruption happens, and suddenly a key ingredient for the economy gets way more expensive. The other kind is demand pull. This is when there's just too much money chasing too few goods. You know, maybe stimulus checks go out, everyone wants to buy stuff, and factories just can't keep up. For our purposes today, we're really focused on defending against that first kind, that cost-push shock.
Before we even start talking about what stocks to buy or what assets to hold, we've got to talk about philosophy. Because the most powerful defensive tool you have isn't an asset, it's a mindset. This is your first and honestly, your most important line of defense. And at the very heart of this mindset is a simple but powerful idea called the margin of safety. This is the absolute bedrock of defensive, value-focused investing. All it really means is you don't pay full price for anything. You hunt for bargains. You buy something for less than you think it's actually worth. That difference, that discount, becomes your built-in cushion. So if you're a little wrong in your calculations or the market just has a bad day, that margin is what saves you from a really big loss. This analogy just illustrates it perfectly. Imagine you're an engineer and you have to build a bridge. You know that trucks weighing up to 40 tons are going to cross it. So what do? Do you build a bridge that can handle exactly 40 tons? No way. That would be completely reckless, right? You build it to handle 60 tons, just in case. That extra 20 tons of capacity, that buffer for bad luck or unexpected stress, that is your margin of safety. It's the same exact principle in investing. So, when you put it all together, you get a pretty clear set of rules to live by. A defensive investor doesn't chase the hot new thing. They stick to businesses they actually understand. That's their circle of competence. They run away from stocks with crazy sky-high valuations, they avoid taking on too much debt, and most importantly, they insist on that margin of safety in every single thing they buy. Look, this isn't about getting rich quick. It's about making sure you don't get poor, ever. Okay, now that we've got the mindset down, let's look at the actual stuff investors have traditionally run to for protection. But notice that little question mark there? Are these things really as safe as we think they are? Some of the best defenses are actually found in certain kinds of businesses. Think about your local power company. They basically have a monopoly, right? We all need to keep the lights on. Or a company with a monster brand, like a famous soft drink. People buy their products in good times and in bad, which gives them the power to raise their prices right along with inflation. We're looking for companies with deep moats and predictable customers. And of course, you absolutely cannot have a conversation about safe havens without talking about the poster boy itself, gold. For literally thousands of years, whenever things got scary or currencies started to look shaky, people have flocked to gold. But its role in a modern portfolio is actually pretty controversial. So you've got two camps. On one side, the bulls will tell you that because there's a limited supply of it, it's the perfect hedge against governments just printing more and more money. It's held its value through centuries of turmoil. But on the other side, you've got the bears, people like Warren Buffett, who point out that a bar of gold is, well, it's an unproductive asset. It doesn't pay you dividends, it doesn't generate cash flow, it just sits there. As Buffett famously said, you can fondle it, but it's not going to do anything. Your entire profit depends on finding someone else willing to pay more for it than you did.
Okay, let's shift gears and move beyond the traditional stuff into some more sophisticated tools. Now, don't get intimidated by the fancy names here. At their core, you can just think of these as a form of financial insurance policy.
So, to really get this, let's use a real-world example. Imagine you're running an airline. Your single biggest, most unpredictable cost is jet fuel, which is tied directly to the price of oil. If oil prices suddenly spike, it could literally put you out of business. So, how on earth do you manage that massive risk? Well, they use a tool called a call option. A call option is just a contract. It gives you the right to buy something, like a barrel of oil, at a price you lock in today for a certain period of time. Now, the most important words there are right, but not the obligation. You don't have to buy it. It's just an option. It's exactly like car insurance. It gives you the right to get a payout if you crash, but it doesn't mean you have to go crash your car. So here's how it plays out. The airline pays a small fee, it's called a premium, to buy a call option that gives them the right to buy oil at, let's say, $70 a barrel. Now, two things can happen. Scenario one, oil prices go crazy and shoot up to $100 a barrel. The airline's insurance pays off big time. They use their option, buy their oil at the locked-in $70 price, and save a fortune. But what about scenario two? What if oil prices crash down to $50? Well, they just let the option expire. Worthless. They lose that small premium they paid, but who cares? Now they get to buy all the fuel they need on the open market at a super cheap price. See, it gives them stability. They're protected from the upside risk, and they still benefit from the downside. All right, we've gone through the mindset, the classic assets, and even some of the more advanced tools. Now for the big finale. How do we put all of these pieces together to actually build your own defensive strategy? Probably the most important thing to get is that there's no magic bullet here. There isn't one single investment you can make that will protect you from everything. A real, durable defensive strategy is built by combining that disciplined mindset we talked about with a smart, thoughtful mix of different tools that are right for your situation. And you know, a good defense can also mean playing a little offense on some long-term trends. If high oil prices, our inflationary enemy, are going to be around for a while, that actually creates some really interesting opportunities. Think about it. High gas prices make electric vehicles and solar panels look a lot more attractive. It makes energy efficiency a top priority, which is great for companies that sell insulation or heat pumps. And, of course, in that kind of high inflation world, traditional commodities like gold and silver can play that classic role as a safe place to store value when cash is losing its punch. So we can build a solid fortress to defend against the risks we know about, like inflation and oil shocks. But that leaves us with one final and maybe most important question. How in the world do you prepare for the risks you can't even see coming? That black swan event that nobody predicted, the one that changes all the rules? Now that is probably the ultimate challenge for any defensive investor.